let's hop into the slides first, if that's all right, guys out there, our wonderful production team. Because, yeah, it does feel timely to talk about what a weaker bond market means for the U.S. dollar, backdrop of this big budget decision, which has a lot of tidbits, a lot of people forecasting what the future of the U.S. deficit will be based on this. So is this
currently,
the full stop?
I believe, $38 trillion.
Is that a lot?
Depends on your scale, but the takeaway is that however they negotiate, whatever they put in, there's about $4 trillion that's unpaid for. So 101 macro is you've got a supply and demand that creates an equilibrium price for bonds. If you add more supply, prices should trade lower. Again, one set of, we know there's many things that drive bond prices. And this really is, we're talking about long-term bonds, 10-year notes, 20-year bonds, 30-year bonds, the long end of the curve as we speak.
Right.
Not the short-term rate. And again, when we talk about what the Fed controls, the Fed sets overnight funding.
Exactly, the complete other end of the spectrum.
Right. So can they go in? And yes, previously when they actually, back in 07 and 08, they bought long bonds to support the market.
Interesting.
And they built a portfolio of bonds to support a zero interest rate environment. Again, that was quantitative easing. So this is letting the market digest what's going to go on. And we talk about the relationship, we talk about carry and FX pairs and the relationship of interest rates to FX. Now we're talking about the long end because that's the piece that's moving right now. 2-year notes, shorter dated stuff, not as affected right now in this particular move. Long bonds are.
Yeah, so just first giving a little backdrop, little context for what the traditional bond-dollar relationship should look like, typically looks like in different environments. But yeah, you nailed it with, in theory, higher yields on U.S. Treasury can bring in foreign investors looking to capitalize on that yield and strengthen the U.S. dollar. When we talk about spot FX, this would mean in a currency pair.
Right.
A lot of those interest rate differentials, one currency priced against the other, which can make that market in particular favorable to go long U.S. dollar, and that kind of flowing through the rest of the U.S. asset funnel. But like you touched on as well, that spot FX markets often have higher correlations to shorter term treasuries, a lot on what the Fed does for overnight interest rates, and less on the 10-year, 30-year. But here we've got, I bring up the Japanese yen.
Yep.
Is what I ran yesterday as
pretty impressive correlation.
Yeah, and this is against
anything above 0.5, we take notice at. And here we've got, again, we're at 0.65 right now, but a median 0.5. This is relevant.
And yeah, ran it against all major currencies, against the 2-year, the 10-year, and the 30-year. Not a lot of correlation between U.S. dollar and a lot of the other major currencies. Japanese yen, the standout, and even among that.
And why do you think that?
A ton of reasons. One of them being this interest rate differential. Japanese yen, another kind of perceived stable economic environment, gets a lot of flight to quality, but has interest rates around 0% for the past 10, 20 years.
We're not talking about 30 basis points of difference. We're talking about 500 basis points.
Yeah, 4 or 5%.
Right.
And then also, they make it interesting by holding a ton of U.S. treasuries, the largest foreign investor, I believe. But yeah, here also on the right, breaking down this, kind of how to interpret this as it's a positive correlation between the yen and the 2-year note, which you can backtrack in inverse, that it's a positive correlation between dollar yen and the yield on the 2-year treasury. So hammering back that higher yield, positively correlated to the U.S. dollar. But as we were starting to get into right now, not a traditional relationship. We had the treasury auction yesterday, didn't go so well. didn't get a lot of, with the expectation of a lot more supply in these markets. When you have an auction, you're curious who's going to buy these. Didn't look like a lot of buyers out there yesterday. Long tail.
Yes, and again, people submit primary. There are 23 primary dealers that are compelled to buy treasuries every time you offer them, and they submit bids, and everybody's got a different price. If they fill them, and then there's a large part of the market that submits what they call a non-competitive bid. I just want to buy the paper. Whatever price is settled at, I will take that price. So there's a mixture of players doing this. What this said is they had to go through a lot of price levels to fill this order, so to speak. In simplest terms, not everybody stepped in and wanted this at certain lower prices, i.e. higher yields. So they had to go down, and tail means you had to go down a lot of price points to get the order filled. And the order being the U.S. wants to sell X amount of a certain duration. So short term, they look at that and they say, okay, there was less interest. It wasn't oversubscribed when you think about an IPO.
Yeah.
There was less interest. It took more levels to fill this order. What is that? In the short run, we had bonds, notes trade down right off of that. Now, does anyone auction determine rates? No, because auctions are very susceptible to a lot of different things. But I think we're at the low end of the range. It seems like the market's looking for reasons to challenge 110 and long bonds and stuff like that. This was a good excuse to push a little bit.
Yeah. And if you're thinking back to the last slide, thinking that if bonds aren't selling, yields are higher, that should be good for U.S. dollar. But I guess the prevailing reason for it now is just low demand, and low demand for U.S. treasuries doesn't necessarily mean...
Right. How do you pay for those treasuries?
U.S. dollars.
Yeah.
So less flowing in that way. But here looking at...
That's your link, and you walk through it very succinctly. Absolutely.
But to your point earlier, looking at the graph on the right here, a lot of lines, but the long end of the bond market, much more susceptible to this kind of long-term outlook of demand. A lot of these budgetary concerns, a lot of, the U.S. credit downgrade, all these stories speaking to, is there risk in the long term?
Right.
And so you're seeing the 30-year bond shoot around 110. You're seeing the 10-year also suffer, but the 2-year relatively staying in. So we saw dollar weakness yesterday, but that a lot of fear behind that as well. And so this rate story in the long term, U.S. dollar less affected in the spot market. Is that correct?
Right. So you would think, well, why can't the Fed then, the Treasury, if they've got to borrow, just borrow 2 years to pay for this extra $4 trillion.
Right.
That's one solution, and they will change the mix of what they do. But the propensity, traditionally, whenever they announce every quarter what the auction schedule will be, there is far more long-dated instruments than short-dated. So it is one tool they could use to mitigate a little bit of this creeping up in longer-term rates, because this does have a direct impact. The longer-term part has a direct impact on things like mortgages, car loans, capital expenditures for firms. So there is definitely a change of shape in the yield curve, because one part of the yield curve, yields are rising faster than the other part. But again, going back to what's the tradable takeaway for us?
Good point here. Oh, looks like, there you go. What this could mean for the dollar yen, because this is the market that a lot of people look to around rate storylines. Yesterday, on this news, this fear from the Treasury auction, saw widespread dollar weakness. But if you're thinking about long term, how to play this story, you're looking at dollar yen here, and I can see kind of two storylines prevailing here, where you could have, Treasury market aside, you could have buyers step into this dollar yen market that looks to perhaps a more sustained carry trade opportunity. than perhaps we thought last year when some of that got shaken out around 160, 150. Now here we're looking year to date, same time frame that we had that bond chart, very different, straight down for this U.S. dollar against the yen. So I could see, a bid tone there, but the yen also has kind of a role to play as a safe haven asset. Could that be a spot that global investors go to instead of the U.S. dollar and start taking this yen back to more historic levels?
And I think you hit on it perfectly, is all these long-term concepts of if the dollar loses its reserve status or Japan decides to lighten up on their treasuries because they're right now anything they own, they're losing money on.
Which would be a huge shift.
And again, they will sell those treasuries. They'll get paid in dollars for them, and they will buy yen. So that actually, irrespective of the interest rate, that means there's pressure on dollar yen.
Exactly.
From a pure arbitrage standpoint or a covered interest arbitrage, which is what carry trade is, should make buying dollar yen more attractive. It's which wins. It's always a confluence of events that drives markets.
Right.
So you keep both contexts in place. The really is, if 5 years is the new baseline for 30-year rates on their way to 6 or 6.5, that's going to challenge whether or not there are long-term dollar holders out there.
Interesting.
If this is 5 years, 5% is a blip, and we're going to go back to that 4.5% range, then you start to see, okay, that's a pretty good stable interest rate differential. The carry trade come back in play. I think that's why when we talk about this, I always am mindful of not going too far down the macro hole, because these are all things that, sure, be aware of, but don't drive your trading decisions. Well, the carry piece says dollar yen should be at 150. Dollar yen is perfectly priced where it is right now, but depending on what you think, and it's always not just the nominal difference in rates at this moment, it's the trajectory of the change in rates.
Right.
So that is really what comes into play here. But I think takeaway for me is these are two big things that are in play. We're going to continue to experience volatility in dollar yen. So that means I am mindful of looking at my levels and whatever they be, 1 standard deviation, 2 standard deviation entry and exit levels. I'm not going to tighten them up to try to get a little bit more active in the market. I'm going to accept that there's going to be more elasticity within these price points.
Well, there you have it for takeaways on what this bond market price action could mean for the U.S. dollar. Look to U.S. dollar, Japanese yen. But that'll take us through the slides.